Hey friends, Lucian here with the Bullish Bears team. I wanted to make this video on physical versus cash settlement with options. So every options contract has an expiration date, and then you're going to choose whether to sell before or exercise your options contract. So just to show you an example here, this is the Thinkorswim platform. You'll see these lines right here. These are expiration Fridays of options contracts. So to add this onto your platform, if you use Thinkorswim, just click this toggle wheel, come up here to time axis, click on that, then click on show expiration Friday, hit apply, then OK. So this tells you again when their options contracts are going to expire. And then again, you decide whether you're just going to, sell your options contract before expiration or whether you're going to decide to exercise the contract and get actual shares. Now, most options contracts typically are just bought and sold. So especially if you don't have a very large account. So if you don't have a large account or tens of thousands of dollars in your account, most options are just bought and sold and they're not exercised. So there is an automatic exercising process that brokers do. I'll tell you that at the end of the video, but it's very simple. You don't have to worry about it. So if you're just, if you have a small account and you're just trading options, you're typically just going to be buying and selling options contract. So you're going to just buy and sell the contract itself. If you have a lot more money in your account and you have a ton of money, then you may decide to exercise the options contract because you want to buy shares of, let's say, major companies at a lower price and just kind of hold them in your account and hold them long term, right? But most options contracts are typically bought and sold. So just got to make sure that you decide to take action before expiration date. But if you forget, your broker will have an automatic exercising process that'll take care of it for you. Now, if you do exercise your options contract, then it becomes either a physical or cash settlement. Now, physical settlement requires that you get the actual physical delivery of the stock, so you would get shares. So in the instance with Apple, if you exercise your options contract, then you would get actual Apple shares, right? Now the shares go into your brokerage account and it's whatever the number of contracts or shares that you purchase. So if you had one options contract of Apple and you exercised it, well, one options contract is the equivalent of 100 shares. So then 100 shares would go into your account of Apple. Now, most options contracts are physically settled, which means that they're easy to transfer and deliver right into your account. So let's do a physical example here or an example of a physical settlement with Apple. So let's say you own an Apple $480 strike call, so you have a call, options contract for $480. Now, if you look at Apple right now, go over here and pull it up. Apple is currently above that price, so it's about $501. At the making of this video, it's about $500, right? So if you if Apple closed, let's say at $520 at your expiration date, you could exercise your option and receive 100 shares of Apple at $480, which is a total of $48,000. So you need to have that money in your account in order to be able to, actually own those shares of Apple, right? But you can just sell, so you can either keep it in your account or you can sell it back to the market at $520. So, if you exercise your option contract at $480 and you sold it back at $520, that's a profit of $40 per share, right? Or yeah, $40 per share times 100 shares. And that would be a profit of 100 shares times $40, which equals $4,000 profit. So if you exercised and you wanted to sell the actual shares back out to the market, you would have made $4,000. Now, again, typically most options contracts are bought and sold, so you would just buy and sell the options contract, and you can make, whatever the whatever you'd made profit, you would just buy and sell the options contract and not have to worry about exercising, receiving the 100 shares, taking those 100 shares and selling it back out to market. So again, most options contracts are basically bought and sold. If you have the money and you want to, exercise the options contract, a lot of people will buy and hold the shares longer. They might not just go immediately exercise the contract and then go and immediately sell it, right? You probably typically just buy and sell the options contract. Those that want to exercise, the option are probably going to keep the shares for, probably a sustained period or a period of time, maybe rather than just that moment. Again, some people might do it that way, but it's kind of either going to be you're buying and sell the options contract or you're going to exercise it and hold the shares, right? So if you don't have a large account, you don't have to worry about it. You could just buy and sell the options contract, but this is just an example of what would happen of a physical settlement with Apple. Now, cash settlement is when, cash settled options are done via payment of cash at the time of expiration or exercising. So this is done when delivering of the underlying security is costly, it's either inconvenient, or even not possible. So an example of this would be the SPX or the VIX, because there's no actual shares that you can own of these indexes. So only cash would be exchanged at settlement. So let's just take a look at an example. Let's look at VIX right over here. VIX is currently at about $26, right? So going back to my example, let's say you own a VIX $20, call strike, and then let's say VIX settles at $30 at expiration. So you are the owner and you would receive a $10 profit per contract. The sellers would pay $10 per contract. So you were the buyer, so you bought low, you sold high, you bought and you have a $20 strike. Obviously, there's different factors within the options contract, but just in theory, let's just say you made $10 per contract. So the seller on the other end, they owe $10 per contract, but they don't have to buy and deliver because they're not going to deliver you shares of the VIX. So they're going to just pay, that's what they owe. So in essence, with physical delivery, you're getting shares of the actual stock. With cash settlement, you're just getting cash. So in these scenarios like the VIX and SPX, you can't own actual shares, so you just get cash into your account. So as far as, again, like automatic exercising of options go, most brokers will do that for you if the options contract is in the money at expiration. So again, things change all the time, but at the making of this video, most brokers do it. So just check with your broker before you start trading options, just to confirm. You want to check their costs for exercising an assignment at expiration. So find out their process. Say, hey, what happens? Call them up and say, hey, what happens at expiration? Do you do it automatically? And then just ask them again their costs. And then if you want to just be safe on the safe end and not worry about it, just sell your options contract early before expiration. That's what a lot of people do, or most options traders do. They sell typically before expiration, but it's not something to be very concerned about. Just call your broker, just ask the process of it. Most brokers are really helpful when you give them a call, a lot of the major brokers, and they'll be glad to help you out. So hopefully this video helped you on learning about the differences between physical and cash settlement. We do, over on our website at bullishbears.com, have free courses to help you, especially if you want to know about options. We have a couple free options courses that'll really take you kind of from soup to nuts, I guess you would say, from beginning to advanced levels of trading options. They're complicated to learn at first. They take some time, but they're a very lucrative trading strategy. You just got to put the time and energy that it takes to learn them. A lot of people say options are risky. Well, trading, anything can be risky in life. You have to learn it, right? But with proper understanding of how to trade them and proper risk management strategies, again, there's several different ways that you can trade options in both bullish, bearish, and neutral markets. And just kind of knowing, we tell people, understand the concept of options. Don't get bogged down in all the minutia of it, because a lot of it is just kind of put together. It's done automatically within brokers. You just have to understand what strategy you're looking to do. Then you apply, know the direction, then look for the strategy that you're looking to apply. Have your proper risk, strategies set up ahead of time, so then it doesn't become as risky or scary as a lot of people think with options. We love options. We teach them in our community. So you can head over to bullishbears.com and take our courses, join our trade rooms. We go over options all the time in our trade room. So if this video helped you, we'd greatly appreciate it. If you like it, subscribe to our channel and share it out on social media. So hopefully this video helped you, and we will see you in our community. Enjoy.